to the most frequently asked questions about Prop 60 and 90 that assessors, and particularly our office, receives. And then if I didn't answer any of those questions, I'm glad to attempt to answer them later. Since Proposition 13 passed in 1978, California voters have adopted and passed additional propositions, 16 of them, as a matter of fact, to provide some additional property tax relief, all on top of Proposition 13. Think about that. Proposition 13 passed in June of 1978. And since that time, 16 amendments to the California Constitution have been passed, granting some additional property tax relief on top of Proposition 13. Two of those propositions we're going to talk about tonight, Prop 60 and Prop 90. Prop 60 passed in 1986 and Prop 90 in 1988. Both propositions do essentially the same thing. They allow a homeowner to transfer a low assessment to a new home and retain the old assessed value on that new home. Prop 60 allows a transfer within the same county, while Prop 90 allows a transfer from one county to another with some restrictions. Several conditions are required in both cases. First of all, both homes must be the property owner's principal residence, both homes. 2, a new home must be of equal or lesser value than the old home. So market value is important. The homeowner must be 55 years of age or older. I don't see anyone in here that's over 55. That's a great line when I'm running for re-election. The homeowner must file an application with the local county assessor, in this case it's my office. And the sale and purchase transaction, and this is very important, must occur within a 2-year period of time, or you're out of luck. And it's a one-time only benefit. You can only do it one time in your lifetime. Prop 60, the intra-county proposition and transfer, is available to all homeowners in all counties by state law. Proposition 90 is optional. The receiving county must adopt an ordinance to accept Proposition 90 transfers from other counties. At this time, there are only 10 counties in the state of California out of 58 that accept Proposition 90 transfers. And they are Alameda, El Dorado, Los Angeles, Orange, Riverside, San Bernardino, San Diego, San Mateo, Santa Clara, and Ventura. Both propositions originally were intended to assist property owners to downsize to smaller homes without a huge increase in assessment, or for family reasons, for example, getting grandma closer to the grandkids. But in practice, however, the statistics show those are not the primary reasons homeowners utilize Prop 60 and Prop 90. Prop 90 comes with an additional controversy. The homeowner is likely to be transferring a low assessed value into a county in which the homeowner has never paid a dime of property tax or voted in an election in his new county. Let me give you an example. A few years ago, a homeowner in Monterey sold a house when he had a $150,000 assessment on it and bought a $1.7 million home in Los Altos Hills. So instead of paying $1,500 in property taxes, instead of paying $17,000 in property taxes, he's paying $1,500 in a new county that he never lived in, never voted in, never paid any property tax in. That's controversial. The term market value can be extremely critical to a successful Prop 60 or Prop 90 transaction. The question I always get is, aren't the sales and purchase prices of both properties the only values that are considered? Well, usually that's true. Usually the sales and purchase prices are accepted in both transactions, but they must reflect the current market value. If If for some reason they don't, one or the other, the appraiser in my office or in any assessor's office determines, and then the appraiser determines a different value for fair market value. We will use fair market value as the appraiser determined. Assessors, this is something to remember in all cases with all properties for all assessors. Assessors must assess property at its fair market value. Now, most of the time, that if there's an open market transaction, willing buyer, willing seller, the property is offered on the open market, I'd say 99% of the time, the purchase price is accepted by the assessor as the fair market value, but not always. If you buy a property and you're able to take advantage of the seller and buy it for less than fair market value, through illness, through they have to move, through all kinds of bad situations for the seller, and you're able to buy it for less than the fair market value, we will assess it at the fair market value, not the purchase price. And we include a real estate commission in that fair market value because that is the normal cost of doing business. Now that begs the question, well, what happens if you overpay for a property? Will you assess it at the lower fair market value? And the answer is yes. We have a classic national case that occurred 2 or 3 years ago right here in Saratoga County. A billionaire, high-tech investor, and company owner, Forbes said he was worth $42 billion, I think it was. He was living in Hawaii after he left here, and he bought a home. His wife didn't like living in Hawaii, and so he bought a home in Los Altos Hills. Paid $100 million for it. It got national in the news, so I was doing interviews with the Wall Street Journal and the New York Times and Washington Post about, wow, this must be the biggest single residential transaction in the country as they wait for it. I don't know if that's true or not. A couple days after it hit the news, I get a call from the superintendent of the Palo Alto Union School District saying, hey, Larry, when are you guys going to enroll that $100 million home? And I said, well, you know, one, we haven't seen it. I mean, there could have been Rembrandts and expensive art inside that they were paying for that is not accessible. So I said, I don't know. But I said, don't spend $100 million worth of tax revenue. He said, why? I said, because it will never be assessed at $100 million. He said, well, isn't that what they paid for it? And I said, yes. And, well, why isn't the price they paid for it enrolled? Because I said it isn't the fair market value. How do you know? And I said, well, the highest assessed value we had in Santa Clara County at that time was $28 million. This was a nice home, but it didn't even have the view. So I said it'll be something substantially less, I'm sure, than $100 million. Well, we ended up assessing it at $52 million. And, you know, it was a difficult assessment because there's not a lot of $100 million or $52 million house comps around. But, you know, there are some in San Mateo County in Hillsborough and Woodside and some of those places that are higher up, like Larry Ellison's home and so forth, in those counties than there is in Santa Clara County. So the best way for me to address the issue of Prop 60 and Prop 90 is to pose and then answer the most frequently asked questions that assessors, and particularly in my office, receive from homeowners. So let me do just that, and if there's a question you have beyond that, or you want to ask about my answer, then we can talk about that at the end. So one question we get asked is, how do I, the homeowner, determine if the replacement value is of equal or lesser value than the original? It depends on the timing of the purchase or the completion of the replacement property. If a new residence is purchased before the original residence is sold, the market value of the new residence must be equal to or less than the market value of the original residence. If the new residence is purchased after the original residence is sold, the fair market value of the new residence bought within the first year can go up to 105%. If you do it within the second year, month 12 to 24, you can go up to 110%. So there's a built-in inflation factor. So example, you got $1 million home. If you sell your house, you can buy one in the first year at 105% or $1,050,000 and still be within the range to accept the Prop 60. If you do it within year 2, you can go up to 110% or $1,001,000. That's very important because if you fair market value is, the appraisal profession is more an art than it is a science. You should, if I send 3 appraisers out to the same property, they're going to probably come back with 3 different answers. They should be within a 5% range. But understand, if you're $1 over that, exaggerating with $1, but I'm saying if you're over that at all, can't help you. And you got to be very careful if you purchase a property before you sell the other one. Got a case here, right here in Saratoga, Los Gatos, a few years ago, where a broker brought a woman in. She had about a $300,000, $400,000 assessed value to buying a property before she sold. You can see what happened here. The market crashed before she sold it, and a $400,000 assessment turned into a $3 million assessment. And there's nothing we could do about that other than feel very sorry about why she got in this situation. Next question. I sold my house a year ago and moved out of the state, and now I want to move back. Can I still qualify for Proposition 60 or 90? The answer is yes. As long as the 2 transactions, both the selling of the original residence and buying of the new residence, are within that 2-year period. Question 3. I'm purchasing a new residence, and I plan to rent it out for a year before I remodel it. And before I move into then I want to sell my original house. Will I still qualify for Prop 60 and 90? Or if I rent my original house for a year and then sell it, and then buy my replacement residence? The answer is yes to the first question and no to the second. Yes, as long as the 2 transaction dates are within the 2-year period, but no, and remember what I said, the original house is not the principal residence at the time of sale because he was renting it, not living in it. And therefore, he was ineligible for a Prop 60 or 90 benefit. Question 4, I bought a vacant lot 10 years ago. I want to sell my present home and build a new home on the vacant lot that I already own. Would I qualify for Proposition 60 and 90? You've got to listen carefully to this answer. The date of the completion of the new construction must be within the 2-year sale of the original house. Same rule. The appraiser will do an appraisal of what the new house would sell for at the date of completion, underscore completion. The market value of both the land and the improvements, the home, is what the appraiser uses to compare with the sale of the original house. And so again, fair market value to fair market value and no more. Next question. Do both spouses have to be 55 to apply? And the answer is no. Proposition 60 and 90 requires that either the claimant or the claimant's spouse who resides with the claimant, that's important, be at least 55 at the time of the original the original property is sold. So actually, if you buy a property at 54 and when you sell your other one, you're now 55, you're eligible. Number 6, I have just inherited a house from my parents under Proposition 58, parent-to-child exclusion. Parent-to-child exclusion. Can I sell my present house and transfer the tax base to a house I just inherited? The answer is no. Both the original and replacement properties must be subject to reappraisal at the full cash value at the time of the transfer. The parent-child exclusion under Proposition 58 does not require a property reassessment. If a Prop 58 exclusion is not used, that transaction will count, but only if it was sold for consideration, not gifted from the parents. So there's got to be money involved, triggering a reassessment of both of the properties. Number 7, if the market value of a replacement dwelling slightly exceeds the equal or lesser value test compared to the market value of my original property, can I still receive a partial benefit? The answer is no. There are no partial benefits. You either qualify or you don't. Proposition 8. Number 8. Is it okay to put another person's name on title, like your son, your daughter, your brother, along with the person who is the claimant for a Proposition 60 or 90? The answer is yes. The claimant needs to be on title in some percentage of both the original and replacement residences, but you can add others to title as well. Next question. The title of my house is in a living trust. Is that okay? Virtually always, but not always. The answer is yes. Same way if you move your house from individuals to a trust, that's non-reassessable. Next question. My spouse and I have gotten a divorce. We are going to sell the house that we both bought together, and I plan to buy a new house. Can I transfer the tax base, or am I only able to transfer half of it? Again, the tax base is not split, and only one of the spouses, can transfer the entire tax base. If you qualify to transfer the tax base at the time, your former spouse can apply for the benefit in the future using other properties, not that same property. I never applied for a homeowner's exemption, but I've lived in my house for many years before I sold it. Can I still qualify? The answer is yes, as long as the homeowner can provide proof that the sold property was owned, occupied as the principal's place of residence, or he or she to meet the resident requirement. Proof of residency is important and may include vehicle registration, bank accounts, income tax records, or a driver's license. Utility bills do not qualify because they might be sent, of course, to a renter, not the owner of the property. How long do I have to live in a house before it's considered a principal residence? There's no time requirement at all, but the claimant must have lived there long enough to be able to prove that the documentation that is valid that I mentioned before. Next question. I think that my realtor or title company already took care of filing my application. Isn't that an automatic grant? The answer is no. Sometimes a realtor may assist, but it is not an automatic grant. You have to fill out an application and file it with the assessor's office and sign it. A copy of a driver's license or birth certificate should be attached to the application. In addition, with an application for Prop 90, a copy of the last tax bill from your original residence is required, along with a $60 non-refundable check payable to the County of Santa Clara. If you are not sure if you filed an application, simply call my office and we'll let you know. How many times can I receive the benefit of a Prop 60 or 90? I think I answered that earlier. It's a one-time grant only. The only time that you can receive this benefit again, more than once, if you become severely or permanently disabled after having previously received a base year value transfer as a claimant, over the age of 55, of course, and your severe or permanent physical disability requires you, requires you to move to a new resident that meets the need of your disability. In other words, you have to have a doctor to say you can't live in that old house now because of your disability, and and then you're allowed to use it a second time, but only when you become disabled after you used the Prop 60 or Prop 90 the first time. Can I transfer my tax base to a manufactured home? The answer is yes, generally with a few exceptions. The total of your base year value is transferred to the manufactured home, but sometimes it is not all that advantageous financially because of the lower cost of manufactured homes. I'm not sure that's true around here so much, but it is in a lot of places. How long does it take to process an application? Well, when we receive your application, we'll send you a letter stating that it could take up to 8 to 12 months. At present, in most cases, it's taking more like 5 to 6 months. We are in the process now of trying to streamline the procedures so that the process can go even more quickly. Proposition 90 takes longer because you're dealing with an assessor in one county and the assessor in this county. And so there has to be appraisals done if necessary on both properties, and we have to depend upon the assessor in the other county to get the job done quickly. Nobody's quicker than Santa Clara County assessor. Shameless promotion.
Yeah. When you
I'm confused about the time limits, somebody asked us. One place says there's a 2-year limit and another place says there's 3 years. So what is it? These time limits are dealing with two different issues. The replacement residence, as I said more than once tonight, must be purchased or newly constructed within 2 years, before or after the sale of the original residence. Proposition 60 and 90 application must be filed within 3 years of the date of the replacement residence, the date the replacement residence was purchased or newly constructed, in order to receive the full benefits. So the 2 years, you have to do it within 2 years, but you can file after that time frame, up to 3 years. After that, there's nothing that can be done. Well, those are the questions that we receive in our office more often. If they didn't cover your question, let me know. If you want to talk about anything else that goes on in my office or what's happening, I'll be glad to answer the question.
Can you quickly, what is Proposition 58 for somebody transferring the family?
You can transfer your assessed value to your child to parent, or parent to child, Proposition 58, without reassessment. You can also do it from grandparent to grandchild, with one serious provision. And that is the parents in between the grandchild and the grandparents have to be deceased. So you have to have a chain that goes from grandparent to their child. I think this provision in the law should be changed. And let me tell you the story. There were some grandparents that wanted to transfer some property to their grandchild, but they couldn't because one of the parents of that grandchild was alive. He was in San Quentin prison for killing the daughter of the grandparents. So he could prevent, in fact the law prevented, that transfer to the grandchild because the parent was still alive. On death row, by the way. So that type of provision in the law, I think, ought to be changed. So that's what Proposition 58 is. You can transfer your property to your kids without reassessment. But you have to file an application and do all of that. Yes, sir.
Actually, that was my question. You have to file an application.
Yeah, I mean, most of this stuff requires filing of an application because the assessor doesn't know until somebody tells us what occurred.
And then a child would have effectively two houses at an older assessed value.
Yeah, they could, sure. And it not only is the house, but it's up to $1 million of assessed value of additional property. Now that's the important part of that is assessed value, not market value. So The parents have owned a shopping center for 30 years, and it's assessed at $1 million, but it's worth 25 million or more. Okay, so you can transfer in addition to your residence to your kids, but up to $1 million of assessed value of additional property, even though that additional property has a fair market value of 25 million in my example.
So one residence plus another million, or $1 million total?
One residence plus up to $1 million of assessed value on other real estate. It doesn't even have to be residential.
And you continue to use that as a business or rent it or whatever.
Sure. Other questions?
Yes.
Excuse me, let me take this and then I'll get back to you. Yeah.
House improvement. Most today's,
The question is house improvements. It has nothing to do with Proposition 60 or 90. The question I get asked a lot is, I remodel my house. Is that assessor going to get me? Well, let me explain that with a personal example. About 15 years ago, I did a major remodel of my house. I live in Sunnyvale, just off of Highway 85 in Fremont. My home backs up to the creek that separates Los Altos from Sunnyvale. I did a major remodel of my house. We moved out for about 4 months. Here's what we did. We replaced every fixture in the house, every appliance in the house, new flooring, new windows, new roof, granite tops in the bathrooms and in the kitchen. We painted it, of course. All new cabinets, essentially, all new lighting, and we added 500 square feet. We added a little bit of square feet to increase the master bathroom, and the rest of the 500 square feet was to expand what was a family room into a great room. All of that was non-reassessable except for the additional 500 square feet. Now, we were replacing what was there. Old cabinets, new cabinets. Old appliances, new appliances. Old fixtures, new fixtures. Obviously, it was substantially better at the end of the river. You wouldn't do it if it wasn't, right? So that's non-reassessable. They added to my existing assessment the fair market value per square foot of a master bath, which is greater than the fair market value of a family room, a great room. They added to my existing assessment the fair market value of the additional part in the great room. That's what was added to my assessment. Now, there's something in the law called substantially equivalent to new. If you gut your house down to the stud walls, we consider that a new house. Obviously, won't reassess the land because you've owned that, and oftentimes you'll get credit for foundation, you'll get credit for sometimes plumbing or electrical, but most of the time when you tear your house down to the stud wall, it's because the plumbing and the electrical are bad, right? So there's some cred that's to be done. But we will look at the interior of that as substantially equivalent to new. If I'd taken my kitchen and did all the things that I did to it, all new, and I'd moved it to another part of the house, that part of it is substantially equivalent to new because I was not replacing just what was there. I'm moving the kitchen around. It's somewhat vague. There are people that believe, and I see it all the time. Well, you just leave one wall standing and you can avoid reassessment. Total nonsense. Never happens. Okay? Somebody told me you can avoid some school fees if you do that, but no, the assessor will always reassess that as a new house. So people think they can do that, but they can't. Yes, sir.
Yeah. Is there a website that someone can go to and say over the last 20 years, just look at the amount of property tax that has come into the county on a year-to-year basis?
Sure. I've been the assessor for 20 and a half years. You can get that information online. I wish I could remember what I don't dial up my own website.
Santa Clara County Assessors.
Yeah.
.com or .gov.
Yeah, something.
Very easy. Just
Something like that.
put Santa Clara County Assessor's Office. Your Google will get that website right
But
away.
all assessed values of all properties are online. You want to know what my house is assessed for? Go online. You can get it. Or yours. We put that online probably about 10 years ago now. Because the assessed value of all property is public record. But I can tell you that I was elected assessor in November of 1994. I took office on January 1st, 1995. The assessment roll that year, when we closed the roll on July 1st, as of values of January 1st, 1995, was $115 billion. The assessment roll we just closed on July 1st of this year, I think it was $380 billion. 115 billion to 380 billion in 20 years. Now, a lot of that's not reassessment of existing
No.
properties, it's building.
Well, you see these strip malls that have been torn down and 900 rabbit warrens being built to go in there. You know that those things you're going to create a tremendous amount of tax base off of those.
I go to Sacramento regularly. Because of my political background, I've been a mayor of Sunnyvale, I'm a city councilman, I've been involved in politics virtually my entire life. My dad was involved in politics in Seattle. So I go up to Sacramento regularly. During the Great Recession, 2009, 2010, I would drive from my house at Highway 85 in Fremont, drive to 237, 237 to Milpitas, and then on to Sacramento. It's about 10 miles from my house to Milpitas, to 880. I would drive during the Great Recession by 6 brand new, totally vacant office buildings. Parking lot was striped, landscaping was in, shells, vacant, either with companies that declined to expand during the Great Recession or worse, buildings built on speculation. If I make that drive today, and I have, all 6 of those buildings are fully leased, usually with major credit tenants. Rambus, Microsoft, Motorola, you name it. You know every one of them. Comcast, you know the names of every one of those companies. And if I drive that today, as I've done, 14 additional buildings on that same 10-mile drive. The 6 buildings that were vacant or filled, 14 new buildings are up. And instead of 3 to 4 stories, they're 5 to 6 to 7 stories. And somebody asked me from the media the other day, well, what's the difference between this boom, I think we're in a boom, and the dot-com boom of 99, 2000, 2001? Is there a difference? And I said a significant difference. Much of the building that went on during the dot-com boom was speculative. The tenants were younger companies, startups, and shortly thereafter, there were oftentimes companies that had no revenue yet, and many of the companies not in existence today. This boom is fueled by major companies, well-known companies making major development investments in buildings, much more solid. I'm not saying we are not. We do have cycles, and cycles in Silicon Valley tend to be much steeper going up and much steeper going down. I tell my fellow assessors, watch what's going on in Santa Clara County. It'll get to you eventually. You may not like it, because you may be on a downturn, but you will get it, and that's true. So we're in the midst of, I've never seen, and I've been in the real estate investment development business for 40 years almost. I don't do much of that anymore. The last 2 deals I did, I built a 257 unit SRO in San Francisco about 15 years ago. and I built a 245 unit family, 100% affordable housing. Both of these are 100% affordable housing projects in San Jose about 8 years ago. My kids will make more money off of that than I do because they're so high in leverage. But it keeps my skill set going, and I think it's doing something that the community desperately needs. But I've never seen the geographic breadth of this boom. Palo Alto to Gilroy, every type of property types. That's a different speech that I give, but I go through every property type, from apartments to single-family homes to warehouses, office, R&D, hotels, retail, and talk about what this current status is of all those property types. Any other questions?
Yes. This school dictates the tax city or county, or is that other item?
Well, I'm not. Let me try to answer your question, and if I don't, then let me know. Question I get asked a lot is, where does my money go? I pay your property taxes. What happens? 45% of all property tax revenue generated in Santa Clara County goes to fund the schools, public education. 18% comes to the county. We can't fund county programs. 14% to the 15 cities in the county, although it varies somewhat between city to city. I've never been able to figure out why. 10% of it goes today to the successor agencies of redevelopment agencies that were eliminated by the government, by the governor, as you may know, during the recession. 8% goes to community colleges. I think it is 8%. 7% to special districts. And if I did my math right, that'll add up to 100%. If it doesn't,
Pretty close.
it's close. Close enough for assessors to work, right? Yeah. So that's where the money goes. Now, you sit. The one predictable indicator of value, residential property values, is schools. Neighborhoods with good schools, like right here, saw far fewer decline in values than neighborhoods that had mediocre or poor schools. And they were the fastest to rebound out of the recession. So my message, and I try to work this into every speech I give, if you own residential real estate, Santa Clara County, and you ever vote against a school bond or a parcel tax, you're not acting in your own financial self-interest, because schools drive the value of what you live in. And Cupertino School, I'm a founder of CEEF, co-founder of CEEF, Cupertino Educational Endowment Foundation, like 30 years ago. But schools, Cupertino, Fremont Union, Los Altos, Palo Alto, Santa Clara, to a lesser extent, is still there. Sunnyvale, to a lesser extent. They're excellent school districts compared to other places. So, I love, and it really makes me angry, because to pass a school bond or a parcel tax today, the jurisdiction sponsoring that tax increase oftentimes has to give senior citizens an opportunity to opt out. It irritates the hell out of them. They got their public education. Their kids got their public education. Their grandkids, when that last grandkid graduates from public high school, they could care less about education. It's just outrageous. But it does happen. People, seniors will argue with me. I had a guy stand up and say, "Yeah, you're right, Larry, but they spend too much money. There's too much administration, and they're not really educating the kids right." I said, "Oh, so they'll do better with less money. Maybe we can starve them into excellence. Maybe we don't give them a thing; they'll be really good." Any other question? Well, yeah.
Can you expound, sir, on the part where you said if a couple is going through a divorce
Yeah.
and one spouse can claim and then the other spouse can claim in the future? How does that work
Yeah,
as far as property?
you only get one of these for each house. So oftentimes in the divorce negotiations, I've never been divorced, but in the divorce negotiations, this becomes an issue depending upon how much money is involved. So only one of the couple, one person in the couple is getting a divorce, can sell that house, transfer the low assessed value to a new one. Either one of them can do that, but both can't, or you can't take partial. But once that's done, the surviving spouse, the one that didn't get the benefit, he or she doesn't lose that one-time benefit, but they have to do it on another house. So let's say the spouse, the other spouse purchases a house, and then they want to do it if they're over the age of 55. They want to transfer that thing later on. They can, as long as it's two separate properties.
Related question: spouses are married by the live apart. Do each of them get benefit?
If they live apart, you only need one person. Okay, you only need one person where it's their principal residence that's over the age of 55. So if you live apart, it's just like adding somebody else to title that doesn't
live
live.
apart, but they live in separate houses.
Yeah.
One person can sell a house and take the benefit, but the spouse can do their own thing also to take
Well-
advantage, right?
Principal residence. So we found this. And you know what happens when you file your homeowner's exemption? It's one of the only things that requires a Social Security number. And then the state runs the Social Security numbers through a computer system. And if we have the same names with the same Social Security number with two homeowners exemption, we ask them which one of you is your principal residence, because you can't have two principal residences. Now it's possible, it's rare, but it's possible. In fact, it happened with the sheriff. She was married. She lived here because she was the sheriff. They had a home up in Lake Tahoe where her husband spent most of his time because of work-related things. And so she applied for and received a homeowner's exemption on her home here, and a homeowner's exemption. He got a homeowner's exemption on his home there. But you only get it one time, and you only get it. I mean, it's like everything else. You have a tax or something like that, and people are trying to figure out how to. Just my advice is play by the rules. Don't try to fool the assessor because it's really hard. It does happen, but it's really hard. All right. Thank you very much for your attention.
I want to thank